Good morning. We will pay attention to the debt-equity ratio today. The debt-equity ratio provides a comparison between the firm's own capital and borrowed capital. Own capital is provided by the shareholders when they buy shares in the company. Borrowed capital is provided by financial institutions when a loan is obtained. This ratio indicates to which extent the firm's assets operations are financed through the use of equity or long-term debt. So you want to determine all the expenses and all the assets of the business. Do you finance it with the capital that the owners provided, or do you finance your business with loans? A firm will be exposed to a higher degree of risk and gearing when the ratio debt financing equity is higher. So the more debts you have, the bigger is the risk and the higher the gearing, because you have to pay back the loan and the interest even if you don't make a profit. So if you have a lot of loans in comparison with the own capital, the risk is higher and the gearing is higher. Gearing explains how a firm finances its operations. They will either use outside lenders borrowing money, or they can get the money from the shareholders. Companies with a high gearing have more long-term liabilities than shareholders' equity. So that means they run the business on loans and not on own capital. They are exposed to more risk as they will have to pay the installments and the interest on the loan, even if the profits decline. Companies with low gearing use more shareholders' equity, own capital, than borrowed capital. They are considered to be less risky because they don't have to pay installments and interest when the profits decline. Gearing is regarded as favorable when funds are borrowed at a relatively low interest rate, while your profits that you make out of this additional loan is much higher. So if you can make more money than the interest that you pay, then the gearing is favorable. Gearing is regarded as unfavorable when funds are borrowed at relatively high interest rates, but the profits that you make as a result of the additional loans will not be higher than the interest rate. The balance sheet of Alex Limited is provided. We have to use the shareholders' equity and the non-current liabilities to compare whether the business used their own capital or whether they used borrowed capital to finance all their activities. Remember that the ordinary shareholders' equity will be the total equity that consists of share capital and retained income, not only of the shares. Retained income actually also belongs to the owners, the shareholders, because it's profit that was not divided between them. The long-term borrowings is the one that will determine whether you use more own capital or more borrowed capital. So don't use the current liabilities here, only non-current liabilities. The non-current liabilities for 2015 was 1980. The shareholders' equity, and then if we divide it, it gives me 48 cents for each rand. So for every 1 rand that the owners provided by buying shares in the company, they borrowed 48 cents. In 2014, the ratio was 27 cents. So that means that it declined, because in 2014 you only borrowed 27 cents for each 1 rand. Now you have to borrow almost double the amount because you borrow 48 cents. The company was more dependent on external financing in 2015 because they increased their borrowings, with the result that the ratio is much higher. So for every 1 rand that the owners provided, they borrowed 48 cents. In 2014, they only borrow 27 cents. Therefore, because they have more loans now, the gearing is higher in 2015, because if you have more loans, then the risk is higher because you have to pay back the borrowed capital and the interest. The firm with a lower gearing in 2014, because then they borrowed less money in comparison with the capital, because the risk is lower when more own capital is used, because the share capital is not paid back when there's a financial crisis and the profits are lower. If the profit is lower, they don't have to pay dividends. So if they borrow more money than own capital, the gearing is high, the risk is high, because they have to pay back the interest and the loan. If their own capital is higher than the borrowed capital, then the gearing and the risk is low, because if they don't make profits, they don't have to pay money back to the shareholders. You have to compare these figures with the firm's policy to determine if it's satisfactory, and you must also compare it with competitors' figures to see if you are in the same bracket as all your competitors. If the ratio is not satisfactory, the following measures could be implemented. Reduce dependence on long-term debt, because the debt and interest must be paid back when profits reduce. So it means it's risky for you when you borrow money and you don't know if you're going to make enough profits to be able to pay it back. Increase your own capital by issuing more shares so that you can increase your ordinary share capital, because you don't have to pay it back to the shareholders, and when the company have low profits, they don't have to pay the dividends back. So for a business, it's better to use your own capital than borrowed capital, except if you can get a loan at a very low interest rate and the profits that will result out of this loan will be higher than the interest rate. The company must compare its own capital provided by the shareholders to the borrowed capital provided by financial institutions. Whether the risk is high gearing, it means that your loans is more in comparison to your equity, and you have to pay back the loan and the interest, so the risk is higher. When the risk is low gearing, it means that you use your own capital. It doesn't have to be paid back if there's not a big profit. Before this company borrows any more money, they must first calculate the debt-equity ratio to determine if the increased profit as a result of the loan will expand the company so that they will make a higher profit than the interest that must be paid. If they can't make a bigger profit percentage than the interest that they have to pay, it's not worthwhile getting the loan.